Hi, and welcome to this primer on financing entrepreneurial ventures. What you'll learn in the next couple of minutes are what investors want and the basis of their valuation of a firm, the different sources of capital and how they compensate for risk, an insight into why venture capitalists demand such high returns, and why equity financing may or may not be appropriate for certain businesses. So a fundamental of corporate value is, at the end of the day, investors want to get their money back along with a healthy return. Therefore, the heart of corporate valuation is how much future cash a firm can generate. In other words, an investor is going to give you cash, they want cash back, and at the end of the day, that's how they're evaluating your business plan. Here's a formula that encapsulates that. The firm value is equal to the net present value of the sum of future cash flows. Fairly straightforward, except that it isn't quite so straightforward. The value is really equal to the net present value of the sum of expected future cash flows. Therefore, value is very much in the eye of the beholder. A couple of examples. In a mature company that has got a history of predictable cash flows and with no changes in their environment, anticipated changes in their environment, it's easy to see that we can project with reasonable certainty cash flows going forward into time, and therefore we can assume that the value of the cash flows is simply a multiple of annual cash flows, 3 times annual cash flow or 5 times annual cash flow. However, when you think of a high growth company, particularly when it's in a pre-revenue or pre-positive cash flow state, a multiple of cash flow is going to yield 0 or a negative value. So certainly of no help to someone who's trying to value the firm. Even in the early stages, in the early revenue stages of a company that does have some cash flows, a multiple of 3 or 5 times annual cash flow would only capture this much of the cash flow and would ignore the potential upside. This is why a company like Twitter with no revenue it can be valued at $1 billion or more, because there's an expectation that they will generate revenue in the future, and it will be considerable revenue based on the traffic and the number of users. Okay, on to the sources of capital. There are a number of sources of capital. This is not an exhaustive list, but it's enough to give you a sense of what the risk tolerance is and how they compensate for risk. So banks, for example, have, as we all know, very low tolerance for risk. Their cost of capital is prime plus 1% or 2 or 3, but some low single-digit number normally. And their primary compensating mechanism is that they will take collateral. So you can't normally get bank financing unless you have some collateral. Under a lease, also low tolerance for risk, but not quite as low as the bank. They compensate for a slightly higher annual risk, annual premium, and they also will take collateral and oftentimes will have an industry focus. So they really understand the industry that they're getting into, for example, the restaurant business. And again, they will take collateral. And there's a few other things that they can do to moderate risk. Mezzanine financing, medium risk, much higher risk than a bank. Their cost is reflects that tolerance for risk. And they also have another compensating mechanism, is that their debt, if they advance debt, may well be convertible debt. And at their option at some future point, in particular if management doesn't meet their objectives, that debt can be converted into equity. Angel and venture capitalists, very high risk tolerance. However, the cost that they demand, their annualized return, is 20 to 40% in the case of angels or higher, and venture capitalists 40% or higher. And they both compensate for risk by taking equity, by oftentimes taking board positions. In the cases of angels, may well demand a management position, the VP of Sales and Marketing, or even the CEO position. And venture capitalists will have many other compensating mechanisms, including something called ratchet clauses, which works like this. If they invest $100,000 in your company and take 10% of the company, and the company is ultimately sold for, let's say, and they would expect normally 5 times their investment 5 years out. If the company sells for, let's say, $2 million, that would make their 10% worth 200. But because they're expecting 500,000, they can ratchet up the percentage of their equity automatically so that it matches $500,000, their expectations. And what this does, it would dilute the other shareholders. So tolerance for risk, certainly, but ways of managing their risk. And then friends and family, we don't know whether they have risk tolerance or not, and the cost is, we don't know, and their compensating mechanism is their love for you, and which may mean that if you lose their money, that Sunday night dinners become a little more uncomfortable. So various sources of capital, and they all compensate for risk in some way. So why do venture capitalists have such a high rate? Let's take the case of a venture capitalist that has $10 million to invest, and they invest in 10 $1 million investments, 10 different companies at $1 million each. This is fairly typical result for them, that they will have 7 dogs, so 5 years out, 7 of those $1 million investments, so $7 million of investment, have yielded nothing. 2 of those investments have turned into lifestyle companies, and maybe through a combination of sale and or dividends, they get $2 million back of their $2 million investment. So they put their money in and they get their money back. So what they're really doing is they're counting on this one last investment to be a home run. And if they invest $1 million and get, let's say, $15 million back, then their total portfolio of $10 million has generated $17 million in return, and that over 5 years yields an 11.2% compound annual return. So you can see that even though they're looking to you to generate 40% compound annual return, their total portfolio only yields 11.2% because of the high risk of their total investment portfolio. Let's put all this into practice, and we'll try to understand what venture capital or angel funding does to your business, and even whether it's appropriate for a restaurant, for example, to look to a venture capitalist or angel for funding. So let's take a look at the year 2011, and we have an operating restaurant that's generated $1 million worth of revenues. Their cost of goods sold is at roughly a third, yielding a gross margin of $650,000. Their general and administrative costs are $500,000. R&D is zero, which is typical in a restaurant, and their sales and marketing might be $100,000, yielding an EBITDA of $50,000. If we assume a 3 times multiple, then the firm value is $150,000. 3 times their annual cash flow is equal to $150,000 in firm value. If they then look to expand, and the cost of that expansion is $125,000. If they get an outside investor to give them $125,000 cash, as soon as that money comes into the firm, their firm value would be $150,000 pre-money valuation plus $125,000 of cash, yielding a $275,000 valuation. The equity percentage of the investor would be $125,000 divided into $275,000, the total new value, which would be a 45% stake. Is that clear? Go back over this and make sure you got this. Now let's roll forward 5 years to 2016, and it stands that if we are to give the investor back 5 times their money, which would be $625,000, would mean that their 45% stake would be $625,000, which would mean that the firm value would have to be $1,375,000. So that makes sense. So again, if the total value of the firm at this point is $275,000, and we need to grow the firm 5 times in order to satisfy the investors, the venture capitalists or angels return requirements, then the total value of the firm must be 1.3 million. And then what we can do is we can reverse engineer the numbers like that and see that that the firm must then, the restaurant must then generate $9 million. So the firm value of 1.375 divided by 3 to get a 3 times EBITDA, EBITDA being 5% of revenue, and then you can just go back up here and compute that revenue would be worth $9 million. I'll leave you to do the math. So then the questions to ask the restaurant are, can the physical plant grow to accommodate this number of meals? So we doubled the size of the restaurant, and yet we have an expectation that we need to generate 9 times the revenue, which is typically 9 times the number of meals. Does the firm generate enough gross margin to make growth investments? Are there indeed enough customers to support 900% growth? Restaurants are typically location-based, and is there enough density and or geographic reach for that restaurant to support 900% growth? Those are really, really good questions, and oftentimes they can't be answered satisfactorily. Let's roll forward to another example. Example 2, a software company, also been in business for a bit, enough to generate in 2011 $1 million in revenue. Cost of goods sold is quite different from a restaurant. It's, let's say, 5%, yielding a much larger gross margin, which they invest in these 3 ways: general and administrative, 150, R&D 250, and sales and marketing of 400,000. Notice that the EBITDA is higher. They have higher gross margins, and they're able to therefore yield greater profit. And so that the firm value is higher right off the bat than the restaurant, which means that if they need $125,000 in cash, the equity investment of $125 would only be 22%, half of that of what we saw in the previous slides. The other thing is that because of the expectation of growth, a value of 3 times EBITDA may be low. We're using it here to be consistent, but it may be low. If it was higher, the firm value would be higher up at the beginning, and therefore the equity that you would give an investor for $125,000 would be much lower, which would be good for you, the founder of this software firm. Let's roll forward 5 years, and we'll see that the firm value, which here was $575,000, if we roll forward, we have a requirement in 5 years that the firm value be 5 times that, so 2.875 million, and then we'll just run the numbers back up, and we'll see that the firm only has to grow 6 times, not 9 times, because of the greater EBITDA factor. And you'll also notice that there's tremendous amount of additional sales and marketing. The restaurant was able to spend $458,000 in sales and marketing, and the software firm, because of the greater gross margin, is able to generate $2.5 million of sales margin of sales and marketing expense, ratcheting up the firm's growth, hopefully. And also, if this is the picture of the firm in 5 years, if the investors need their money out, just temporarily or slowing the rate of spend on sales and marketing or even R&D will create revenues to fall right to the bottom line. So lots of advantages here, and this is why venture capitalists and angels are much more likely to invest in this type of firm. There is no physical plant that bounds the growth of the firm, and geography doesn't necessarily limit customers. So we'll kick over to the finance worksheet, which is for Royal Road students, available on Moodle. And this is a very simple model that allows you to run through a potential angel or venture capitalist investment in your business. So it's designed to provide a quick reality check. We assume that angels and VCs typically want to see a return in the range of 5 to 10 times their investment in a 5 to 7 year period. So we'll start with 5 on 5 and just answer these 9 questions. How much money does your business need? And we'll just use the restaurant analogy here. $125,000. What percentage of the company are you willing to give up for this investment? 45%. In how many years does the investor want their money back? 5 years. They want 5 times their money back. We're going to use 3 times EBITDA to value your business. The percentage of sale, your EBITDA is 5%. Your sales, the average person purchase of your intended customer is $120. So that's a couple with a good meal and a bottle of wine. And your customers will come to visit you every 2 months, so 6 times a year, and your restaurant is going to be open 7 days a week. So I'll run you through, you can run through these numbers, pause here and run through these numbers yourself. Whoops. It didn't work the way I wanted it to. Hold on. Okay, sorry about that, but here you can assuming a 7-day week, you'll need to make 211 sale transactions every day in the 5th year in order to generate revenues of $9 million that will support that investment. I'll leave you to play with that. It's a good little model, and we'll get back to the slideshow here. And finally, the lessons to sum up. Investors want their money back along with a healthy return. All this has to do with cash. The value is in the eye of the beholder, and you need to understand the potential sources of capital available to your venture and write your business plan accordingly. Hope this has been helpful.